Three, two, one, episode 9 of the All In Loyalty podcast. We are back on schedule, back on track, hopping in once again to keep everybody up to date on everything in the world of loyalty industries, the loyalty points programs, rewards, everything there is to know, everything that has happened that has any sort of significance, you're going to learn from us. So be sure to tune in. We're always here, basically every 2 weeks, covering all of the latest news, and oh boy, has a lot been happening. So we had a little bit of a longer break between the years. So between like December and January, we had our predictions episode just before. And now we're going to be diving into some of these headlines that we've been covering, and we don't even have time to catch up to what's happened over the last like 2 months, because just recently there have been all sorts of big pieces of news that have been coming out. So really, really excited to actually dive into some of these, because all of these are, some of them are business specific, some of these are company specific, but I mean, some of these topics today actually really causes you to zoom out and look at everything from a larger scale, and actually almost forces you to look at these things from a perspective that didn't necessarily exist before. So that's definitely something interesting. But for now, let us talk and let us get a little bit of intros going. So let's start with Gianluca this time. How are you, sir? How are things over in Dubai? How's your health, et cetera, et cetera?
Thank you for your concerns and asking about my health. I'm doing great. Yeah, fantastic. I'm wondering if maybe last time when we had the podcast, maybe I was a bit under the weather, because in fact, it was getting colder in Dubai, as much to my surprise as maybe to others as well. It was around 15 degrees. I know it's not cold per other standards.
So not colder, but less hot. I see.
Less hot, correct. No, but jokes aside, all good. Yeah, feeling ready for this podcast and super excited about the topics that we're covering, since they're going to be very, very interesting. As you said, a little bit more macro, I feel like, than sometimes when we go in the depth of how rewards programs work.
Straight over to you, Gabriele. How's everything on your end?
I'm doing very good. Arrived yesterday from Dubai back. I actually got a bit of a cold, since it was very cold in Dubai. No, I have to say it was not, again, like compared to Swiss, where it was still hot, but I was wearing my winter jacket because I felt actually cold. No, very good. Excited about the topics today. I think there are some very cool things happening in the loyalty market, and excited to discuss them with you.
Fantastic. Well, then let's dive right in, because this first topic was one that you actually recommended, and that we did a bit of research into, and everybody here is kind of a fan of the All In podcast. And just a couple weeks ago, they were in Davos, so actually not too far from you probably, Gabriele, and they were meeting with all of the different politicians, and it was a very business-centric one apparently. You had all kinds of names there. Basically, anybody that had any sort of importance and that was making deals was over there. And one of those people is the CEO of Circle, because we have, going into our first topic of discussion today, we're talking about stablecoins. And it's very interesting because it kind of feels like a full circle moment. Pun not intended. But that was actually not intended. But yeah, a full circle moment, because we had talked about before a couple of like blockchain related topics as they relate to loyalty and rewards, and always talking about them as like a subsection or something like that. And now we're actually diving into a topic where it sort of is starting to set the stage for the fundamental, tech and process and basis with which people can start looking towards stablecoins as a means of getting something back, right? And for the longest time, when people talk about using money, using currencies, they talk interest. Things are going to be changed up a little bit here when it comes to digital currencies. This has always been a thing, for the longest time. However, it's been getting more and more attention lately, just because it's been getting covered, and there's been some significant legislation being built around it, with the different acts that have been coming around. So the Clarity Act, the Genius Act, and yeah, it's been very interesting to follow some of this stuff. But we're going to dive into a couple of interesting points, especially when it comes to Circle maybe in particular, but also in stablecoins in general. I don't know, maybe Gabriela, you'd like to set the stage when it comes to the way that stablecoins were seen in the past versus the way that they're going to be looked at in the future. I don't know if you have any like takes here, if you have any predictions, but it really looks like they're starting to become that fundamental layer and is getting a lot of like not just businessman attention, but kind of retail attention as well. So are there any thoughts that you want to put in here before we start looking at some of these interview excerpts?
I mean, maybe just if you look a bit at the history of stablecoins, at the end of the day, the first, I would say, was actually first retail driven, because was used mostly on exchanges. So when you were trading crypto, to basically sell BTC, sell Ethereum, and so on, and then park it in a stable currency. That's why the stable coin. So it was more retail driven. I think the world is waking up, and a lot of businesses, mostly the payment space, financial institutions, etc., they're moving massive amount of sums around the world. Basically, start seeing that it's the ideal settlement currency to basically have instant settlements between different parties, and just moving money much faster, much cheaper around the world. So I think businesses are really starting to understand that. Again, this movement was mostly driven in the past by USDT, which is Tether, which is also not, I think they're in the British Virgin Islands or something like this. So typical crypto setup, and obviously people just do not, let's say if you want a big bank that basically then starts sell in stable coins, they most probably don't touch a company that is in the British Virgin Islands to basically move billions and billions around the world. So USDC basically made a very the choice basically from the beginning to be compliant and to move in a direction where they can actually offer something that institutional clients can use. And now with the Genius Act in the US, basically giving more and more guidelines, standards around how to use stablecoins, etc., there is actually a real potential that we see stablecoins being really the instant settlement layer for all the world. I still believe it will be in that background, so I don't think that retail customers will see in their bank account USDC, but it's rather that in the background the money is being moved in USDC, and then you as an end customer have at the end of the day the real advantage to send money 24/7 around the world, very cheap. Again, we're in 26, we're talking about AI, robotics, flying cars, all of that stuff. And then if I want to send somebody money over the weekend, it just doesn't work. Like I have to wait until Monday. So it's time. It's really time to to honestly solve that part. And USDC is the perfect, or stablecoins in general are the perfect means to make that happen.
It feels like a natural progression of things, 100%. And another angle with which people are talking about its inevitability, has to do with fees. Of course, that's also been one of the big ones when it comes to like interchange fees, etc. Usually when you want to do big transfers or whatever it is, there's always some sort of fees. And people are talking now about being able to sort of convert something like that. Instead of paying 3% to a bank, you can pass value from fees, for example, directly back to the customers as a sort of reward or whatever it is. The topic of rewards is one that we've been sort of discussing a little bit, and now just recently we had the All In podcast host JCal interviewing Jeremy Allaire, who is the CEO of Circle, so that's USDC. And we have a little bit of an excerpt here, because while they do talk about the infrastructure in general as a whole and the attitude with which banks and things like that have been, like how their attitudes have changed towards it over time, we also have these experts and this excerpt from the interview talking about how they're approaching rewards and what the Genius Act has done to clarify this. So let's just dive into that real quick, and then we can dive into some takes a bit later.
As a result, under the Genius Act, Circle, as a payment stablecoin issuer, we're prohibited from paying interest directly to stablecoin holders. It's the same thing in Europe. We're regulated in Europe. Same rules. Same thing in Japan. All these markets, it's the same. But at the same time, like we're building a business. We do generate revenue, and we work with lots of different types of platforms and markets and distributors and brokerages. We work with everyone from Robinhood to Revolut to Coinbase to Visa and lots of companies. And so those companies, stablecoins are really important too, because they are how people hold money, how people make payments, how people trade, how people do a lot on those platforms. And so they want to be able to have the ability to pay rewards or have loyalty programs or incentives and other things. And if they're making money from their relationship with us, they want to be able to do that. And that's what the Genius Act captured. And I think really, I think it's good. I think it's a good model. And
so you're happy with it as is?
We think it's a very solid model. And I think really there's some ongoing discussion about, well, is there a specific set of things that qualify for those kinds of like loyalty and rewards and other things? And how prescriptive should the law be? And it's kind of getting relitigated a little bit.
Yeah, so they switch subjects from there, but talking about the relitigation. So just to put everything into a brief summary, just talking about the way that the stablecoins work, it's basically the way anybody would expect, the sort of digital money thing that you can move money around and that you can use it to buy, sell, whatever it is. And he was talking about the partnerships. He was talking about how USDC is a revenue generating company, and that they work with, basically all of the big sort of investment platforms that are out there. He mentions Robinhood. He mentions a bunch of he mentions banks in general. He mentions Visa. And yeah, most importantly, he's talking about how the Genius Act is able to sort of capture the dynamic between entities like USDC and the companies that they work with. So these Robinhoods, these whatevers, and like dealing with how exactly they distribute the rewards. And if you listen to the way he reacts to it, I think he's like, I don't think he would say he's happy with it, but he's like satisfied with it to a certain degree. And it looks like, based on his the last 5 seconds there, a part of those sections are parts of the Genius Act that are being relitigated. So yeah. How about a little bit of feedback, maybe from you this time, Gianluca, first, about when it comes to stablecoins, first of all, your take on the subject matter in general, but then secondly, if you see this stuff happening and moving forward and, just being an inevitability versus an uphill battle when it comes to USDC and some of these other stablecoins in particular.
So in terms of stablecoin in general, so high level, I'm pretty sure it's going to happen. I think it's inevitable. In fact, I think what Gabriele mentioned before with the level at which it's being used. So again, just in general, how these stablecoins will be used. I'm very curious to see to what levels it's going to be used. I also believe that at the beginning, it's most likely going to be just a background, more so a technology rather than an actual payment method or than an actual utility, and more so a settlement mechanic where banks have a certain security. As Gabriele said, if I want to send money now on a Saturday to him or back and forth, we can't really do that nowadays with traditional methods and banks. So having that stable coin in the background that acts as not as an escrow mechanic, but like as a mechanic where the bank receives the money in USDC or in stablecoin terms, and then it's sent to me and I see it on my bank account, or Gabriele sees it on his bank account over the weekend. I think that's probably going to be the first level of how it's going to be used. And then who knows, maybe further down the line, it will also be used in the hands of people directly. The biggest challenge that I see is the whole wallet topic, which of course it's completely a different topic. We don't have to go into that now, but it's definitely something where just if you then go to the masses, that's where the struggles begin. And that's where the whole then crypto topic and do I understand how this works and do I understand how to work with it? That's where there's massive hurdles when it comes to people. But I think as a mechanic, as in general, it's excellent that they're pushing it forward and that banks also open up a little bit. I think also in part due to the fact that they are seeing it also as a potential competition, because if you're using if it goes in consumer direction and they do somehow crack those challenges, the banks will have some issues, because if the whole world transacts on a peer-to-peer basis, there's no need for a bank. All you need is the networks, and USDC or USDT or whoever the stablecoin provider or issuer is, to keep their networks running and to make sure that it works as intended. And then it's just me sending money to you, you sending money to me, and there's no middleman. So I also think that banks just want to get in on this so that they can capture some sort of business with it. I mean, in the end, banks are businesses, so they have to capture some sort of business from it and just be part of this movement so that they're not left out. So
to
long
your
story
point,
short, go ahead.
Sorry, I was just going to go and say, to your point, exactly to your point, actually. On another excerpt from the conversation, Jeremy Allaire actually talks about how in Davos now, they have had more conversations with banks, and banks have approached them more than the last couple of years combined. And it's just generally seems to be that way always with new technologies, right? You have the companies, you have the people that resist, and you have the people that recognize its inevitability and try and figure out the parallels and where they can dive into it. So yeah. Gabriela, hopping over to you, first of all, maybe if you have any sort of comments on maybe what Jeremy Allaire says about the attitude with regards to some of these other bigger providers, the banks, the exchanges, the brokers, whatever. And then maybe I'll have a follow-up question for you afterwards. But let's first, we'd be curious to see your takes on the statements from Jeremy.
I mean, I think in general, the main issue so why banks want to use stablecoins, again, that's because of reconciliation and settlement topics. I mean, you can save a lot of money as a bank just because you don't have to work with players like Swift, for example. So if I want to send, I don't know, $100 from a UBS account to a Bank of America account, there is just a relatively costly process right now in place. It takes an eternity until the money arrives, etc. And that's just not how the internet works at the end of the day. If you go online, everything is just instant, and money is just not current money rails are just not built for an era of internet, although we have internet since now 26 years, even more, but I would say commercially from 2000s on. So that's the crazy part, that we still work on a rail that is just completely outdated, and that has nothing to do with new cultures, new dynamics, new generations, etc. So I think from that perspective, banks absolutely see the value. And not only banks, again, there are payment providers like a Stripe, for example. There was also in the conversation we're talking about QuickBooks, which is accounting and an invoicing tool that basically processes trillions of dollars of invoices. Obviously, again, everybody, if you have a business, speed of money is one of the most important things, because if I make an invoice, I want to be paid as fast as possible so that I can actually make all my payments on the other side. So there is a huge cycle where speed of money has a huge impact, and I think banks see that. It makes also sense for them to adopt it, either to decrease costs for their customers and increase the experience, or on the other side, just to capture more margin because they actually can increase the whole experience, right? Because if I was charging $10 for a transaction and it cost me as a bank maybe $5, and now it costs me 50 cents, that means that those $4.50, they're mine now. So I can actually make much more money on that. I think where banks have a bit of an issue is on the yield topic, meaning that if a USDC can actually give me as a holder yield for just holding stable coins, what happens is, at a certain point as a consumer, I don't see the value of having USD on my normal bank account where I don't get anything. So I will actually get that money out of the bank. I will transfer the money to USDC and obviously hold my money there. Now, what that means is you could have potentially a bank run, meaning that all the people actually go to the bank, get the money out. And as we know, a bank gets the $100 from me and then gives Gianluca $100 of loan from my $100. Meaning that if there is my $100 are not around, that starts becoming a big issue, right? And that's where I think banks are pushing back a lot right now. I have to be honest, it's also kind of weird in the sense that just for holding a currency, I basically get a certain yield, because right now, today, I can basically buy a government bond where I actually lend money to a government and they give me a certain interest rate. But basically, I lend them the money. So they use it then for infrastructure, for education, for lending that money to banks so that they can give loans, etc. So there is like a value of me providing money to the government, and that's why I get a certain yield, right? The same thing with the bank. If I leave money on a bank account, on a saving account, or there are certain different products where you can block it for 30, 60, 90 days, etc. Actually, the bank works with it. So they lend again that money to another customer, to a company, etc., or they do their own trading with it. So there is actually value being generated because I leave that money there, right? And that's why I get rewarded with a yield. If I just hold money on a wallet and nobody actually profits from it, because I don't see the value of USDC profiting from me just holding that money, because it's anyways a stable coin. So you don't have that sell pressure in the sense that like with a BTC or with a Ethereum where actually it makes sense, right? If I stake my Ethereum, they're not in circulation, meaning that there's less circulation, price goes up. So there is a clear pricing dynamic there that makes kind of sense why getting a reward on just holding. So it's basically like a government, like let's say the Swiss government giving me a reward just because I hold Swiss francs on my bank account. There's no logic in it. And also you want money to move. You don't want money to be stuck on a bank account, because you want that people either consume that money, they invest that money. Obviously they have to save also money, but it's not like it gives a completely wrong incentive. The more I save, the more I get, because then that money doesn't go into circulation, which again, no consumption, no investment, etc. So it's kind of, stablecoins have a lot of benefits, huge amount of benefits when we talk about reconciliation and settlement. The topic of getting a yield for holding it, I'm not really sold on it. Let's call it like that. Why that should actually generate value. Again, if you look at DeFi protocols where, for example, I lock my USDC and then Januga on the other side can lend those USDC, that again is a completely different logic, because there's actually value being provided, right? I don't need that USDC right now. Januga needs it. So he pays me basically an interest. The DeFi protocol gets a certain percentage of it, and he gets basically his money to do whatever he needs to do. So there is value being created on that, and then it's understandable. But just for holding stablecoins and getting a yield.
But isn't that exactly the case that we see now with all the platforms, all the crypto platforms, where whether it's exchanges, whether it's maybe some type of custodial wallet platforms, where you hold your USDT or your stable coins or any other altcoins and you generate yield on it? It's the same concept as with banks. I have the feeling it's a small it's a small battle between the banks who, as you say, if I have $100,000 and I put them in a bank account and I don't even know if bank accounts give anything on saving accounts nowadays. Maybe there's like super small differences between banks to capture more customers. But let's say it's like 1%, maybe 0.5% in a certain bank. If I know I can convert that into USDT or USDC and put it on Binance, OKX, Coinbase, whatever it is, and they give me 10% or 5% even, doesn't matter really, because it's more than 0.5% or 1% I get there, then I will take out all my USD from that bank account and put it onto those platforms. I think that's where the battle is. It's not like at least from what I understood, maybe I'm misunderstanding the whole topic, but I doubt that I would receive yield for holding USDC on my own hard wallet, whether it's if it's my own wallet, I doubt that because then I don't understand what I was about to swear what they're talking about.
No, but that's what he's saying, that they're making revenue, and obviously from that revenue you can actually then start giving a yield, right, to someone. I don't think that the issue is that a Binance gives me a yield on that stablecoin, because at the end of the day, what happens there is they use their money for their own trading internally. Yeah. So they actually make more money, and with that they can actually give me a yield, right? So I don't think that is the issue. The issue is really that the stablecoin provider gives you a yield, or at least that's what I understand, just for holding. And I think in another part of the podcast, they were also talking about that just the holding can't be rewarded, but you actually need to do an activity. So it's like the more you're trading, for example, so the more volume you're actually creating, right, the more you're getting rewarded. Or again, if you're lending it with a DeFi protocol, etc. So there is value being created, and that's why you can get a yield.
So it's in fact actually almost more a battle between the stable coins in that case, because then stable coins could push their advantage by saying, hey, use USDC instead of USDT because we give you, I don't know, 15% yield on holding your USDC instead of having USDT.
I think it's not really, because again, if you look at USDT, they anyways have an issue because they're not regulated.
No, I'm not saying.
So like the USDC wins from that perspective anyways, because if you want to, let's say, be able to sell and operate in the US market, you just need to be compliant with all those regulations. And if USDT is not in the US market, it's in the British Virgin Island, they can do whatever they want.
Yeah, they're not.
Obviously, at a certain point, you get blocked, right? So I think the conversation is more around current existing incumbents that just like see a threat of, I think, of a bank run, honestly, that people literally run to the bank, get their money out, and that is a huge issue for banks, because there are certain regulations on how much leverage can you take, for example, on the money that you actually have on your accounts, right? So there are all these topics that have a huge influence on the operations of a bank, on the actually like on a bank being able to survive. So the more people think, USDC is actually a very cool option to, let's say, save money and get something on top, the more people will run to the bank, get their money out, and then you will see more and more banks having an issue. And that's why I think they're pushing back and trying to actually capture that market share by them adopting that, and then giving you the reward for that. So for banks, it's more using a new infrastructure and being able to moving money around much cheaper and much faster. And they just make sense because you have cost of money. The more the money basically is not in your bank account, the more that money costs you.
We do have, though, being stated in the interview that they are talking to a lot of banks. So I guess a lot of them are actually trying to adapt rather than resist. I'll start to wonder what that will actually end up looking like in the future. I don't think that's quite 100% clear yet, but we can maybe have an interesting conversation moving back away from like the actual stablecoin legislation and more towards the actual, rewards and loyalty side of it, because that's still like quite an ongoing conversation. And when we get to something with that level of scale and we talk about rewards and loyalty, we're talking about it potentially affecting a huge number of people. And that sort of starts to bring up the question of loyalty dilution and things like that. If a customer can easily swap, for example, one brand's points for another or something on a secondary market, or if one, like we heard the conversations about all the exchanges. We heard Revolut, Robinhood, banks, and Visa, for example. Where does that end up looking like when it comes to the consumer? Is there going to be some sort of rat race from all of these entities to try and figure out the best way to become the most rewarding platform in terms of whatever the leading stablecoin is? Or do they issue their own stablecoins? We've seen that in the past with PayPal and a couple of others. I would love to know if there's any takes about this and how this is looking like for the future, because we all know the conversations are happening. We just don't really know yet what those are going to yield later down the line.
No pun intended.
True. I've done that twice now. What's up with me?
No, I think that basically what they're talking about right now is okay. Stablecoin issuers can't give any yield, so let's give them a reward, basically, to token holders, right? Also, that one, if I understood it correctly, needs to be connected to actually certain activity. So I actually use that stablecoin, right?
As per the Genius Act from last year, not the Clarity Act from a couple days ago. Exactly.
Correct. So, and I think that opens up a really, really cool conversation. I mean, just from a loyalty perspective, that means a massive amount of market that is being created, because right now, market is like you have an airline, you buy a ticket, you get miles, and then I use those miles. So that's like the loyalty transaction right now. If you actually take USDC and let's say it grows more and more and more, and it replaces more and more, let's say, the legacy USD, that means actually that you have on a huge amount of volume, you will start actually seeing rewards going out. And imagine that you have the USDC point, right? So for every transaction you do, you get some USDC point, and then those points maybe can be exchanged through airline miles, etc. I mean, say for us as a business working in that space, that is huge. That is really, really huge, and will just bring a huge amount of volume to the whole market. So that's for sure good news, and I think it's actually a very, very interesting model, because it goes into the, let's say, a classic loyalty solution, right? And it goes around of the whole yield topic. So I also think that will be difficult for banks to prohibit a stablecoin issuer to actually reward a customer with some points, as an example, right? Now, question, what you said before, like who actually gives them the most amount of rewards, etc. You have that issue anyways right now with credit cards. Like Amex is competing with Chase, like they're all competing with each other because obviously they want to get as many customers as possible that use their credit card. So the loyalty program for credit cards is the USP that they can offer, because the more they actually can give from that perspective, the more customers they can get on board. So I think it will go exactly in the same direction, with the difference that you just have players like a USDC, a USDT that are so far ahead. It's like almost like you want to create a new card network and you want to start competing with Visa, MasterCard, or American Express. You can. It's just very hard. It's just very, very, very hard, and will cost you so much money. So I think getting new incumbents, or let's say new players, into the market with the USDT and the USDC already being very, very far ahead will be anyways difficult. So I think it will be then more between those two and maybe a third one, like as you mentioned before, like PayPal did their own stable coin, etc. So yeah, I think there are a lot of questions around that. There's also a lot of questions around how are these stable coins actually being used. I really believe that 95% of the transactions will happen in the background. So end customers won't even see that there is stable coins used behind, but they will just get the notification in the bank account, hey, from today on, you will be able to send money instantly everywhere, anywhere in the world, with a much cheaper fee, right? So that's the information that I will get as an end customer in my bank account. And obviously that makes me happy, because I know I don't have to think now 3 days before Christmas about making all my payments, just because on Christmas they will shut down everything and there's no transaction being done. That's one part, and the other part that I actually save money when I send money around. So I think 95% of the transactions will be in the background. Neither merchants nor end customers, etc., will actually get that there is a stablecoin being used in the back end, and a very, very small amount of end customers and merchants will actually use stablecoins. And we see that even by ourselves from the solution that we're working on, that we always have the conversation about, okay, we can make instant settlements between loyalty program merchants, etc., with stablecoins. And then always the question comes up, okay, but then what do we tell the merchants and the loyalty programs? That they have to buy stablecoins now and send it to their wallet and then send it to our smart contract. Just with that sentence, you confuse everyone. And if you then think about loyalty programs where you have multiple levels of from, let's say, management to operations and so on, that actually have to, first of all, approve it, understand it, and then use it, it's almost an impossible task. And so you have to think like, okay, how do I sell this to a 5-year-old? And selling it to a 5-year-old really then means you just get your money faster. That's it. You get your money faster. You don't have to write an invoice, for example. So you don't have any reconciliation costs. You save money, you save HR costs, etc. But it takes just a lot of time to change habits of people. And when you touch money, it's not something easy to change your habits on, because money is, I think after health, everybody sees money as basically their top priority, and what they want to save and keep secure as much as possible. So for sure a multi-year process, but again, like everything, it just takes time, and then the whole paradigm shift.
I have an interesting, maybe an interesting follow-up. Sort of one of the number one ways nowadays to get, like, for example, some of the most traditional rewards like airline points or hotel points and stuff like that is through co-branded credit cards a lot of the time. Do you see actions like this eventually leading to, like, do you see what's happening now with USDC and its potential for the future eventually like replacing the model of something like a co-branded credit card, or do you think this is going to be something additional that people, like an extra option for people down the line?
You mean the using of the stablecoins or the yield side?
Yeah, like not necessarily now, but just acknowledging that maybe like as time goes on, these stable coins and stuff like that is going to be able to be used as a rewards mechanism. Yeah.
I mean, I think that stablecoin providers will want to give an incentive to holders, right? And to users of their stablecoin to just incentivize, literally like an airline, like a credit card, use my product, you get rewarded. So the same logic will apply to stablecoins, right? But I don't think that will change anything to the from an end customer perspective with a co-branded card, or let's take American Express, for example, where you can exchange membership rewards to Delta Sky Miles, right? Now, I think the American Express buys around $5 billion worth of miles each year from Delta, right? Now, if you think about it, what happens is I use my Amex, I get my points, I exchange them in Delta miles, right? So I use all these miles, all the customers from American Airlines. At the end of the month, what Delta Airline needs to do is basically, and that already takes a huge amount of time, they have to check how many miles did the membership rewards consume, right? So pull that data, check it, send it to the accounting team. The accounting team needs to write an invoice. That invoice needs to go to American Express. American Express needs to check it. There's always mistakes because there is it's an organic reconciliation issue between those two parties because they don't use the same database and not the same ledger. So they anyways need to make that check, right? And then there are questions back and forth, etc. So from these miles being used, so where Delta actually should get their money because those miles went out, until they actually get the money, maybe takes 2-3 months. Now, if you calculate on a $5 billion, say, volume per year, just take 3% of a basic interest that you would get if you put that money to work, right? That's $15 million a year. So that's $1.5 million a month. That money, the longer it's not in your bank account, the more it costs you. And that's where really the issue is. Like, there is a huge amount of cash just being wasted because there is like super legacy processes behind that are completely normal, like checking that the invoice makes sense and that I'm actually paying the amount I should pay. And if you think about $5 billion divided to 12, that's 400. That's basically receiving every month an invoice of $400 million. Obviously, you check that. And also there, if you have just 1 or 2% reconciliation issues, we're talking about $4 to $8 million that per month are off. That on a yearly basis, we're talking then about $50 to $100 million. So we're talking about real money that just is basically being wasted because you have to reconcile databases, because you have humans that actually need to write invoices that make mistakes. You have humans that have to find the mistake. You have humans that have to negotiate about who actually then takes over that mistake and that responsibility. So, and again, it's just crazy in 26 that we have these topics. Like a process that is, again, it's math. We're not talking about we need to launch a rocket. That never was done before, right? It's literally just like taking money away from one account, putting it on the other one, and with stablecoins, yeah, you can solve a huge amount of these issues and make it instant. So I think there lies really the beauty in it, that you don't have people sending invoices back and forth, but money just flows exactly how it's being used back and forth, and nobody really needs to worry about was it reconciled correctly. Do I need to check something? Do I need to write an invoice? Do I need to make a payment? I mean, imagine to make a payment for $400 million. That's not like when we do a payment to pay a bill for, I don't know, $400.
Yeah.
Like there are a few different instances that have to be signed, that have to sign off a payment like that. and already that takes time. So it gives
But
a
honestly,
huge amount of value to these kind of transactions. There you will see change. There will see change. But for the end customer, the change will be I can instantly exchange my points to miles, which already
But
is a
honestly,
big
I'm
benefit.
not 100% sure about that, you know, because one thing that I realize now, also hearing that excerpt again of that interview, is that if it's something that they're talking about, first of all, even considering the fact that they're rewarding holders or users, he doesn't specify exactly what that word is, but people who use USDC, and that there's certain discussions around the topic of giving back to these users a certain yield, whether it's in USDC or whether it's in rewards. To me, I'm going to take back what I said at the beginning, and I believe that there is more belief in end users actually transacting with USDC than we think, because, and also maybe we also think in a way about wallets that is a little bit, I would almost say, old now, thinking about the crypto market being relatively young, but still, you know, with a hardware wallet, and you think about, you know, MetaMask and all those web wallets and connecting everything. When nowadays you can create a Coinbase account in no time, it is a custodial wallet, but you can basically, there's also Coinbase wallet, which is then your wallet. And I am pretty sure that in the near future, there's probably going to be, or if they're not even thinking about it right now already, working on maybe even physical wallets that resemble credit cards, where you don't even need to create accounts, where it's just a hardware wallet that instantly transacts with payment systems and makes it so easy to receive USDC on it, and makes it so easy to pay with USDC that they might even think actually the whole end user customer using USDC is a bigger topic than we think. And it's not just a back end, not just a Rails topic. And actually one thing that I also realize now in the conversation is that I think this is pretty effing incredible, actually. Thinking about the fact that a currency gives direct rewards. So let's say that they bring it through and it is a loyalty, it's in the form of a reward system. So not direct yield, but in the form of, let's say, points. As Gabriela said, maybe USDC points or something like that. It's so cool to think that for the first time, we have a currency that rewards you. It's not the credit card, it's not the shop, but it's the currency itself. And that is only possible because basically public. And did I disconnect?
Just for a second,
2
but you're
seconds.
back.
Okay. Yeah, just to cut it short in case it happens again. But it's just so cool to see that just using the currency directly. So imagine I have cash, $100 bill, I go buy something, and I magically get points for using that money. You know, when we talk about reward programs being easy to use, being easy to earn, being easy to spend those points, credit cards is one of the first things we think of, because a credit card you need to spend. You need a credit card, or let's say you need some sort of card payment method to make payments. Credit cards is one of the very basic ways of doing it. And that's where you get points. But here it's the actual currency itself. So that's super cool to see. And I believe if they manage to bring through the rewards, first of all, I hope that it's more in the direction of reward and loyalty and less in the direction of yield, because I think the whole yield topic is a bit too much on the nose, and it then also sounds and looks a bit too much like a financial instrument. And the whole loyalty program and reward system is more commercial. I think it also speaks to more people. Of course, everyone, if you say, hey, you get 10% of what you're holding every year paid out on a daily basis, of course, everyone's going to be like, okay, cool, I'm going to put my money there and I get something in return. But as we also speak about gamification and everything, the whole experience also makes a difference. And I think there, in terms of loyalty program, definitely going to be more interesting for consumers than yield. as also that, just what is yield? Not everyone understands that. But if you say, hey, you get 100 points for every dollar you spend, or every USDC you spend, that's definitely going to be something interesting. One other thing that I was also thinking about that I'm very curious to see how the future of that is in terms of the whole loyalty industry. When you have a massive player, or not even massive player, when you have a concept as massive as the currency that you're using to spend or to purchase whatever it is, services and products, gives you points, you're basically earning points 24/7 the whole time, no matter what you do, especially if it's in use, if it's all points for use of the currency. That loyalty point itself is going to become a massive currency, because especially if you want to make it useful, because obviously what's the point of them launching a loyalty program where you get points and then you can't use them for anything? They will have to also think about that. That's going to be a whole other topic they'll have to think about. Which, of course, as we know and as we've talked many times, is a loyalty point is only as valuable as the spend options that you have with it. Because if I can only get merch like the PS5 one or the Sony one, then I'm not going to be so excited about it. But yeah, I'm really curious if all of this in the future will also push more legislation, or more ruling around loyalty points as a currency. Because in the back of my mind, one thing that looms all the time is, if loyalty programs and loyalty points become so big that it becomes so liquid, I'm sure that we will be in the same situation as Circle now with USDC. Because then the topic is going to be like, okay, wow, if the liquidity of points is so efficient that I can use points to buy things, then they'll probably also want to somehow regulate it in a way that it doesn't get out of hand, especially if multiple stable coins get into it and the world goes into a digital currency first, like positions in that, and then through everything you start earning points. And the competition becomes on how to spend those points. So all the stable coins that do issue points, they then also have to compete on how much they give out in terms of points and how much can be spent, or how versatile their spending options are. If the competition goes there, it's going to be like, these points are going to be so valuable.
Yeah, but you have the issue that at the end of the day, the currency provider itself, again, it's the infrastructure, it's the settlement layer. So the amount of fees that they can earn from that is fairly small. Where they make a lot of money is by basically buying USD bonds and basically lending the US government money and then getting a yield on that, right? So they generate cash on that. But you still have the issue of how do you actually pay with a stable coin at a point of sales? So you have already, like, credit cards are completely, or debit cards with Visa, MasterCard, Amex.
Who's to say someone's working on a card, on a literally one-to-one physical card that works perfectly as a wallet with which you can transact directly, or even mobile phones.
Yeah, but you also need the merchants to be ready.
No, but that's what I'm saying. If you can
both sides.
Of course.
It takes a huge amount of work to actually create the same.
But if they're talking to banks,
have to think about.
If they're talking to banks, it might be a rail. If they build the rails essentially that through all payment systems, you can pay with stable coins. Doesn't matter if it's physical or if it's with the phone.
It will 100%.
There's no challenge.
100% stable coins won't be used by retail. Like, there will be a very, very small amount, because you have so many technologies in place that are already working perfectly. At least they have a huge consistency. They're there, they're built, and it will be. If you have a card, you need a point of sale system that accepts that card. So
I think it's just a matter of time. It's the same thing as why would you have a mobile phone without buttons? once someone
feel
told
like
to Steve Jobs.
maybe
Steve
I feel
Jobs
like
said, you
you
don't need
you
one.
might.
You have buttons, but they're on the screen.
Touch screen.
Yeah. So
I think there might be correctness on both sides, but just on different ends of the timeline potentially.
No, Arno.
Like I do.
You have to pick a side.
I'm not picking a side. I'm not picking a side. I think the infrastructure layer and the tech background layer is going to be 100% correct and true, especially in the short term. So the next couple of months to half a year and everything. I do think that eventually, and it's not necessarily going to be called USDC. It might just be rebranded and called something else. But there would be
USD.
some sort of wouldn't that be simpler? There would be some overarching loyalty point format that could then eventually reach the masses, and that will be enabled by this propelling of USDC to fuel some of these other exchanges. I could see something like that happening eventually too.
I mean, look at it from a market share perspective. So if USDC achieves that banks use them in the background, payment gateways like Stripe, etc., use them in the background, we're talking about covering 95, like a Visa using them in the background. We're talking about 95 to 99% coverage of the market. Trillions and trillions and trillions of dollars. Why do I have to spend so much cash on building new point of sale systems or building new payment gateways, etc., that are just working for my USDC to capture the rest 1 to 5%, which is basically nothing?
No, you don't, because Stripe is
That's it. Yeah, but
taken care
correct.
with.
So you, as a stablecoin provider, you don't have to talk to the end customer. You
No, but
work
you
with
want
Stripe.
you as
work
a
with
stablecoin
Stripe.
provider, you want the whole world to adopt your stablecoin and none other.
If you cover 95% of the market, you're fine.
Yeah.
You will even have issues, and you will try to say that you're not covering 95% of the market, because then you have regulations coming in and say you have monopoly position. Exactly the same as Google had to do with the ad space. So
Yeah,
Oh,
I think.
So you're saying
time
why
will
have
tell.
loyalty point rewards if you're already like owning the whole market, basically?
that, and also on what do you actually give out loyalty points? I mean, it would be amazing, of course, if there is like such a huge player giving out points. Again, it would be
Yeah,
amazing
but then
amount of
why are they
volumes
even
that
talking about it? Why is it such a big topic?
Maybe that's the form universal basic income is going to have. Sorry, random, very
And
weird
the AI
tangent. But
No, but I think that they're talking about it because they have a certain incentive of pushing, maybe because they also have a bit of a kind of go-to market where they want to have end customers using their stable coin. Again, we don't know how far they are with what.
Maybe it's a crypto thing. You're like,
I
we don't
honestly,
have
yeah, for me,
we don't have utility. Let's just say we have rewards.
the conversation. That's why I said from the beginning, I don't see it as a
They're just
currency.
degens like all other crypto degens.
Yeah, like I don't see it that a currency gives you a reward just for holding their currency. It doesn't make sense. It actually
No,
hurts
but they
the
don't say
market.
for holding, right? They say for activity, for usage of the tokens. So it's not for holding. It's
Yeah,
for
but also that,
transacting with.
like, if you can work with a partner where you essentially don't have to do distribution to the end customer, you work with one bank, with one payment gateway, etc., and then the rest is being done by them. I don't see the value, the added value.
Okay.
well,
Maybe
I
they don't
guess
want to
we'll
become
have
a
to see.
commodity.
Yeah.
Because at the end of the day, if you look at credit cards operators, like an American Express, their brand, like the brand awareness of an American Express, is much more premium than a Visa or a MasterCard. Like Visa, MasterCard, nobody really, obviously everybody knows them, but it's like, it's kind of a brand. Yeah, on my credit card I have Visa, but like you're connected to your bank actually. And there is much more, say the brand American Express has much more attention from end customers and much more value from that perspective than a Visa or MasterCard. Maybe that's what USDC or other stablecoin providers see themselves, that they don't want to become and go in that direction where they're like a kind of a commodity and nobody really cares about them. Yes, they're a big brand, but there is no really touch point with them.
Fair. I think it'll be I think it could be the year of the stablecoin. I think, well, like whatever it ends up being, we're going to see the stage set this year. And the fact, Gabriela, that you mentioned Visa in your last statement lets me just hurriedly move this over to the next topic, which is actually a great segue, because we were talking about the co-branded credit cards. We were talking about it's actually a topic that we've discussed multiple times. And with that sort of, we have a bit of a crossover. We had a LinkedIn post from Lancey Joseph talking about and shouting out an article that we can dive into a little bit in a second. But this is apparently from Visa, talking about how they're urging banks to rethink loyalty beyond credit card rewards. So actually, like, again, kind of addressing the issue that we've been talking about lately, which is about the sort of, I don't want to say archaic, but like outdated version of a lot of these things, and the very, very fast changes that are currently happening in the space. I mean, we've talked about the big move from credit card-based loyalty to debit card-based loyalty, where Revolut was leading the charge, which we've seen happening more and more. And in general, like, we've seen this happening in general. And yeah, just putting in some interesting statements. The future of loyalty is not post-transaction. It's not limited to credit card holders, and it's not funded only by card economics. It's embedded into the payment itself, inclusive by design, and powered by merchant-funded rewards, delivered at the moment of spend. Seeing Visa leadership quickly articulate this shift tells us the market is converging where loyalty needs to go. Generally, guys, agree, disagree with this statement? I think it's pretty hard to disagree with this one. What do you think?
I mean, yeah, in general, the user experience of these, let's say, the systems are, like, just as an example, when you pay with points right now, I know it's from American Express and from I think Mastercard, they all have the same system. So you pay a transaction at a merchant, and then they basically tell you, hey, you can cover this transaction with points. So you click on it, points are being deducted, and cash is being sent back. Like, idiotic in the sense that, I mean, idiotic. I don't want to hurt anyone's feelings, but at the end of the day, it's not a state-of-the-art customer experience. Like, what you want is, you want to be at the point of sales, you decide I want to pay with points, you click on that, you swipe your card, points are being deducted in the background, cash is being settled with the merchant, and that's it. So that would be the perfect user experience, right? And obviously, the other point that is being talked here about, funded only by card economics, 100%. I mean, that's what we're working on a lot, is basically getting more smaller merchants to connect with frequent flyer programs like Airmiles and more, and others, because you as a member have more options to earn and spend your points, right? But on the other side, it's not just funded by the credit card itself, because a credit card transaction fee is not huge. So as an issuer of a credit card, I really have a limited amount of power to actually reward my customers. And if you have the merchant itself that actually says, hey, this is something super interesting, I want to reward my customers with this specific point or mile, and I actually fund this specific point of mile, again, this currency becomes more liquid. So 100% agree that we're going in that direction. I think the main question is how you get it done, because it takes a lot of work, and we see that ourselves. We onboarded last year over 150 partners for Miles and More in the SME space, and it takes a lot of work to actually educate them, onboard them, manage them, and see that they use it the right way. So it's easier said than done, but it's not impossible. We proved that, and I 100% think that it goes in that direction. Payment with points, I think the main issue with payments with points is the rate, honestly. And I'll make an example. Just the flight to Dubai that I just took, it cost 100,000 miles, as an example. The flight in cash would have been $9,000. Sorry, not 9,000, 9,000 Swiss francs. So basically, the value per mile was around 0.09 cents, which is super high, super high, right? With those 100,000 miles, I would get, I think, gift cards from Amazon worth around 300 Swiss francs. So 30 times less than that flight, right? Meaning that
Right.
there is the issue of actually the different rates that are being used between I spend my points for the brand's products, right? Or like in this case, the flight. And as soon as I go out of the ecosystem, I have such a low rate that I don't even want to spend those points because I know the value that I'm getting back is super low. So I think that's the biggest issue, and it's not the issue of not having the technology or merchants not accepting it and so on. As we see, a lot of merchants are super happy to accept miles and points as a payment method, right? But on the other side, you then have the end customer that just sees no value in that. Because they have to decide between spending my 100,000 miles on a flight that could be between $4,000, $5,000 and $10,000, or a 300 euros gift card, or I don't know, a room that costs €100. It's a super easy choice. So I will never go with my miles there. And that's from our perspective, that's the main issue. And we actually see it reflected in the numbers. So all transactions on our side are for merchants are, I would say, 95% on the earn side. So they're actually distributing miles, right? And a super small amount is on the spent side because people tell themselves, like, either they're like, okay, I anyways have these miles, I don't earn a lot, let me just spend them. It's like a fuck it moment. And then they just go and spend it, right? But people that understand a bit the value of these miles, they would never spend it outside of the ecosystem. So it's more on the loyalty program side to actually try to maybe get those rates a bit closer to each other, so that I have more liquidity as a customer, and I see also more value spending those points at other places.
It's still so interesting having conversations when you meet new people and talking to them about loyalty points and economies and whatever. If someone asks you, at a bar or a party or whatever, what do you do? I work in the loyalty sector, blah, blah, blah. And you actually explain it to people. They will often bring up the example of miles. And a lot of the time they might have like a basic understanding of it. But even the fact that, for example, you have more value redeeming like the airline's own things rather than partner things, they never thought about it before. But once you mention it, it's like, oh, that's so obvious. So it's like, okay, I could afford this huge intercontinental flight in business class, or with their partner company, I could get a suitcase, and it's like, well, it kind of depends on what you want at the end of the day. But the fact is that they just have those things that are available. And maybe the day would come there where you'll need a suitcase more than something like that. But the fact of the matter is, yes, like if you have money and you need to spend it on something in particular, it would be awkward then if suddenly the exchange value for that was like super duper disadvantageous for you, and then you ended up having to spend it anyway, right? That's like, that makes for a pretty nasty example.
Yeah.
That being said,
I mean,
sure.
just one small note. What, of course, we can't forget is, which is obviously a bit misleading, the price of a flight is never the cost of that flight for the airline, right? So that's why obviously the rate seems kind of super high, but the value that you're getting is of, I'm not spending that money, I'm spending miles. So for me as an end customer, I make the calculation amazing. I just saved $5,000 on a flight because I bought it with miles, right? But for the airline, maybe that flight costs $500. So then you're much closer again to the rate of going out of the ecosystem, because outside of
if
the
you think like that, then you also have to think about the suitcase, the $300 Amazon.
It's economics. Like if I have a liability of $1 billion in value, I need to take care that $1 billion doesn't go out like that, because most probably I don't have $1 billion in cash on my bank account.
But the consumer doesn't think about that.
No, they don't think. I know they don't think about that. But I'm just saying, at the end of the day, a company is math. You need more coming in that goes out. And obviously, if I tell my customers you can spend points outside of my ecosystem with the same value that I give you inside of my ecosystem, you will have a loyalty program run. It's not like a bank run, but you will have a loyalty program run. So everyone will go spend their points, and you will see a lot of airlines just going bust because of that. I mean, we're like US Airlines has have around $8 to $10 billion liability on their balance sheets. And that's cash. Like that, if that money goes out in a year, they're done. Like they're done. There's really nothing they can do.
It's always a bit of a game there, isn't it? Goodness.
Yeah, 100%. That's why the point the value goes down is like a real issue. And the thing is really, it's just economic. It's just normal economics. You show me a price of 5K, that seat costs you $500. And that's why when I want to spend my points outside of the ecosystem where the loyalty program actually pays that, right? Like if I get an Amazon gift card, they have to pay the Amazon gift card.
Mm-hmm.
And they don't
Indeed.
pay then on the $10 gift card, they pay 50 cents or $1 on the gift card. They pay $10.
Right.
So that's where the mismatch comes.
And with the progression of this, I'm trying to find the perfect segue to delve back into the article. I feel like when we're talking about then the progression and evolution of loyalty systems, it was a very interesting article to read. And it does have to do with, sort of rethinking the way that companies approach loyalty in the first place. And this is on payments. It's an interview with Avery Walter Miller, who's the vice president of loyalty solutions at Visa. And they have a couple of excerpts and quotes from him. There were some very interesting ones here that I thought we could break down. First of all, there was this one here explaining exactly how it works. Saying historically, credit cards generated a margin. So rewards and marketing were designed to increase card spend. Miller said that the structure is still common across the industry, with larger financial institutions investing significantly more in those programs than smaller ones. The result has been a market where loyalty appears fundamentally similar across issuers. Seems to be true, but margin pressures on interchange and fees mean banks can no longer rely solely on card economics. It becomes essential to find new funding sources. Loyalty is more dynamic and competitive than ever. Consumers are enthusiastic about rewards and will often sign up for programs immediately, but they are overwhelmed. On average, individuals are enrolled in 18 or more loyalty programs. I'm not sure about that number, but with the rest of the statements, it's very interesting because I also, when I read that, I was thinking, I mean, yes, and also people are just parking their money in other places. If you make things seamless, if you make every app, frictionless, if you want to, you used to have to be, for example, an accredited investor in the US if you wanted to invest in certain like stock options or commodities or whatever it is. And they've sort of removed that through things like Revolut and Trade Republic and Robinhood and all of those things. People have been moving their money around. And it has been almost a sort of monopolistic sentiment when it came to the credit cards and stuff like that. So it's very interesting to see this expectations conversation happening. It really makes you wonder, the level with which, or the attitude with which, I guess, people approach loyalty programs as, potentially value generating, rather than actually being something to invest in. So I don't know if you guys have any takes based on these first couple of quotes from Avery Miller, but yeah, definitely an interesting way to start, I think.
Maybe what is interesting to know is the topic of who funds these rewards, right, from credit cards. They're playing quite a not dangerous game, but it's kind of a gamble because they have different, mostly credit cards, let's say credit card issuers, because those are the ones that actually pay the rewards. So a bank that issues a Visa or a MasterCard, as an example, they get money from the card network itself. For the merchants, they get money basically for the transaction itself. Then they have to give part of the card network and part is their revenue. And some of them they can actually to keep for them. So one is the transaction fee. The other one is the FX fee. So every time I have a Swiss credit card and I spend outside of Switzerland in euros, in USD, in AED, whatever it is, then there is a certain FX fee that comes on top, which is another revenue stream. And then you have obviously subscription fees. So if I have to pay $200, $300, $400, $500 a year to get that card, that's also revenue. Last but not least, it's the whole when you pay in installments, the whole interest rate that they basically charge. So those are mainly the revenue streams that they have right now. Most of the times, the rewards are not tied to one or the other, but it's basically, okay, we make revenue on these 4 streams, and then depending what card you have, we give you this reward, right? So also there, it's kind of a gamble because you basically pay out a certain amount of rewards, but that reward is not paid by one clear stream, but it's an interplay of all these streams, and you have to see that you actually earn enough on those transactions, so that you can actually pay the reward. So it's also not a super, it's not like the flight. I spend $5,000 on a flight and I get 50 or $100 worth of rewards back, right? It's quite of a gamble. So making all these rewards more merchant funded makes a huge amount of sense, because it really deleverages the issuers themselves and gives an additional benefit to the merchants when they actually issue out directly these rewards.
Mm-hmm. Yeah, I mean, it's what I was most interested in. I'm honestly like I'm learning in real time here, because a lot of the things that you're saying here I'm hearing for the first time, but that's good. That's good. That's the entire purpose. But if we want to delve in, I mean, first of all, Gianluca, hitting on your side here. First of all, just based on the subject matter that we're talking about right now, if you have any interesting takes, and then maybe just touching on what Gabriela said, even though that was more in like a sort of educational context, but yeah, would still love to hear from you in this case.
Not specifically to add anything, but to what he said. But yeah, the merchant funded rewards, I think shifting also there, the focus, very essentially what we're doing in that sense, that the focus is not anymore on the issuer, on the credit card. As I also mentioned before, with credit cards, obviously they're a payment method. Whatever you do, you earn those points or miles or whatever it is that whatever loyalty program it is, through the credit card payments. If they move it more towards the merchants, then essentially it's also a question of here when they talk about banks rethinking about the credit card point system, or essentially moving the issuing of the points towards the merchants and less towards the bank. It's also a bit of a question of, do these banks issue their own points? Do these banks have loyalty, a frequent flyer program maybe that they work with, and they issue miles from that? So it's also there a bit of a question on how it works. One thing for sure is if they move the focus to the merchants, or the merchants are the ones issuing the points, it also is closer to the merchants having their loyalty program, or having a loyalty program that they issue the points through. So it's also a bit of a question of, where does the loyalty lie in? Is it then more on the merchant side? Is it more on the bank side? So it's interesting. I'm still trying to wrap my head around what exactly the statement is here when they say merchant funded rewards. Because to me, it's also then a bit of a question of, okay, who is the main player that is issuing, and is then the consumer loyal? Is the consumer loyalty on the merchant or on the bank that they're using?
Well, one of the big...
sorry, just one last thing. If it's merchant funded, as a consumer, I would assume that then I would hear it through the merchant, independent of which bank or which card I use. So there, my loyalty
Depends.
My sense of loyalty would be towards the merchant.
No, it depends. Like you can, that's just the bank working with different merchants and basically opening up to the merchant a direct way to participate in this campaign. So the bank would communicate, for example, through their channels to all their credit card holders, hey, by the way, this month you can go to, I don't know, this gym as an example, pay with our card, and instead of getting 1 point per Swiss franc or per euro or dollar, whatever it is, you get 2 or 3 points. So the merchant gets a huge amount of exposure to all these card holders, potentially new customers that flow in. So that would be basically a way how to make merchant funded rewards through the bank itself. So it's less of our model where we go to a merchant and tell them, hey, why don't you issue miles to a customer, and they then communicate it directly. So it's literally more a customer not more, but it is customer loyalty in the sense that I reward my existing customers with a certain benefit, instead of the bank saying, okay, I'll make a big boost. I communicate you to all my cardholders, and if they basically come and purchase your product, we pay the first point that we give out. You pay the second point that we give out.
This is directly, practically directly addressed actually in the next segment here. If you look at the second half, when they talk about data, they mention the engine behind the entire shift is data. Banks already hold high-quality behavioral data that can be used to understand preferences, timing, transaction patterns, and intent signals. Partnerships extend this capability further. Merchant-funded offers give banks a way to deliver real value without draining their own economics. Miller described these offers as a compelling addition for banks because they introduce a new funding source for rewards. Merchants benefit from larger baskets, better conversion, and access to new customers, and consumers see richer offers in more places. At a time when bank revenues are tightening, Visa is helping shift loyalty economics away from pure card P&Ls. Banks can reward behaviors like bill pay, deposits, wallet provisioning, or digital sign-on, which yield lifetime value even though they don't necessarily produce revenue in the moment. I guess when you sit back and think about that, I mean, I guess from like a data perspective, then it suddenly becomes very clear, right? Which entity would have more data than a bank when it comes to a lot of these behaviors and everything? So from that angle, I mean, it makes a lot of sense, especially now if we see the head of, or the VP of, what was his exact title? Vice President of Loyalty Solutions of Visa, actually directly targeting this. It makes you think that, you know, that is sort of an inevitable road. And if Visa is working on it, then you can be sure that a lot of other institutions are approaching it in their own way too. I mean, you guys have already sort of talked about this to a certain degree, especially Gabriela. Just last episode, you were talking about the importance of data when it comes to the personalization of a lot of these programs. Do you guys have anything else to add when it comes to the data angle and the way that these would work with some of these new funding models?
I think in this case, data is just an enabler to do these merchant funded rewards much more accurately. Make a simple example, like if I have my customer pool that use my credit card as a bank, I can send an email to everyone that this gym now offers a certain campaign, or actually check who is spending money on sports equipment, on gyms, etc., or maybe who is spending too much money on food. So I have both my target groups, the ones that already train and the ones that should train, and I actually send them the I would be the first candidate that actually receives that email. You should maybe go more to the gym and buy less food.
We have noticed that you spend a lot of money on fast food. Here's an offer.
Here's an offer, go to the gym. So I think that's where data helps a lot, and at the end of the day, it helps from different perspectives to increase the conversion rate, that you actually have a segment that is interested in that specific offer. On the other side, that you don't spam all your card holders, because if you just send every time to all your card holders, doesn't matter if it's, for example, a product more targeted to women, you shouldn't send it to guys, because most probably they're not interested. Like, and the other way around, the same. So data just helps a huge amount on that personalization topic. Again, not spamming people, increasing conversion rates. So I think it's more, that's the helpful part. Obviously, then also to tracking actually the success of a certain campaign, because as a bank, you see all your card movements, right? So you know, okay, this week I sent it to, just saying an example, 100,000 people that offer, and now suddenly I see the transactions on the cards, 10,000 transactions. So I exactly can show also the merchant, hey, look, it worked. And we had this bump on additional customers. This was customer acquisition costs, etc. So data, I think, is more to bring a lot of transparency and to make the whole process more efficient.
100%. And I think even from a consumer sort of perspective, I would rather get sort of promotions that are directly tailored to my needs and my histories, rather than something that you know has been mass produced to everyone. Like, the attitude changes. I mean, you used to know if you got an email that, okay, everybody received this email, you know, but now with the progression of everything, I mean, again, this is one of the first topics that we talked about with the AI personalization and everything. It will be using this data and saying, hey, you appear to be into, jogging and a bit of gaming and stuff like that. We've got these cool offers for you and everything that you might find interesting. I would read those. I would look into those. I would be much more likely to. I think it would directly affect sort of open rates too. I would love to see a difference in open rates versus like the mass-produced ones versus the personalized ones. But yeah, definitely very, very interesting. And I mean, the final like slide on here is talking about the sort of AI angle to this entire thing. And yeah, they basically say it's accelerating every trend in loyalty. It'll make it easier for consumers to find the best deals and optimize targeting, segmentation, and relevancy. But it also creates a new competitive frontier. So Miller says, in the world of AI agents, we are actually going to see the fight happen for every single transaction. Instead of competing for top of wallet, issuers will compete repeatedly for top of mind. It's really interesting the way that it is reshaping the way people sort of approach this stuff, because I think that it brings more relevancy then to two things. Number one, AI agents sort of mathematically looking for the most rewarding platform and you using that. And then B, the power and impact potentially of using the emotional angle of loyalty. Because on one hand, when it comes to the mathematical part, on my side, for example, if you're the type of person that will just go wherever the rewards are best, if you have like a cool AI loyalty bot or rewards program bot that you can use, and it'll say, okay, purchase from this place regularly for the next year and you'll get this much back, or you'll be able to claim this. That seems cool. At the same time, there is that little angle that's missing. And this has been kind of, and I don't want to get too like woo-woo about all this, but from a psychological standpoint, what people have been talking about has been the sort of retransitioning from optimism and what's it called? Generally just optimism and looking for hope in the future and everything, towards what in the recent years has been a sort of general tendency towards the nihilistic and the fatalistic. Nowadays, moving towards that place of, hope, and we're actually growing and we're getting a little bit better and we're improving. And it feels like from an attitude perspective, believe it or not, I think that there's an angle with that when it comes to brand loyalty as well. If you're into a brand, if you really like one, if you think it's doing great, whatever, that sort of power, that sort of following, if you have someone like that dedicated to a brand, I think that means something. I think that's important. Sorry for getting like this level when we've been sort of business analyzing this entire time. I do think that's going to be something that's very relevant later on, and it's going to cause businesses where it makes no sense the fact that they're growing to the speed at which they are, to suddenly like get a lot of attention. That being said, you cannot discount math. So that means in general, when it comes to rewarding and being good and being seamless and being easy to use, those are also going to take some significant sections of the pie.
And I mean, loyalty is 100%. Like, there is also a cost of loyalty for consumers. So I think it goes so far as, for what I pay, I get actually a good quality, and there is more tolerance towards the brands you actually love and you let's say you were born with, let's call it like that. But there is always a tipping point where you as a brand always need to be very aware that if you don't deliver the right quality and that your price doesn't match, no amount of loyalty will save you. Because people won't overspend on bad quality just because.
I will. Whenever I hear that, I will always put Apple in front of everything. When did it become normal?
No, but that's completely different.
That a phone costs over $1,000 when a laptop costs the same.
No, but that is like, Apple is a very special Not even
Nah.
Apple, but the product,
They're-
itself, because you have a certain lock-in effect, meaning that you have all
Yeah.
your data, all your tools. But
Yeah.
just think about a hotel room, a flight, even a credit card. Like, you can be as loyal as you want towards an airline, but if they cost double as much and they don't deliver the right value for that, and you have the other airline next to it where you get exactly the same from A to B, you get exactly the same point, it costs less and you get a higher quality. As loyal as you are, at a certain point, it will tip and you will say, you know what, that I'll go to the other and honestly, I can talk from experience. And I experienced it on this Dubai flight again.
And
I'm like, there is
the pain,
there's
the pain
products
of
and products.
change. The pain of change is
Yeah,
always
but if that's
it
low,
always needs to be greater than
Yeah.
less than the pain of staying, right? Otherwise, you will never change. So
100%. But that's
in
why
the
when
end,
the pain is low, or the pain of change is low, these brands need to be very careful to deliver good quality for the right price. As soon as that swaps, and again, the pain of change of a laptop or of a mobile phone is much higher than just flying from A to B or staying
Yeah, of
7
course.
nights in a hotel.
yeah, of course.
So that's what I'm saying. It depends always from the product itself, and how big that pain of change is. But like, just wanted to say that loyalty is, and you can create it with community, with the brand values that you have. You can treat your customers and call them by their name, etc., etc., etc. But if I have to pay 10K for a seat that then doesn't even work, and on the other side I pay maybe 7K,
But-
it works perfectly.
No, but
There is no question.
We're living
there's
in
no question.
2020. We're living in 2026. If you switch iPhone to Android or Android to iPhone, it literally takes like 10 minutes to do the switch. You connect them and it's done.
But it's emotionally,
I mean,
at least for me,
exactly.
emotionally, it's like
emotionally
I
exactly.
have to
So
change, and I have to learn now a
your
completely
identity.
new No, but you have to learn a completely new operating system.
They're all the same.
No, they're not the same. 100%
Literally,
not.
I could. There's not even a
No.
keyboard difference. Remember, it's just a screen.
No,
no
it's not the
buttons.
same. If I couldn't go back to Windows now. I couldn't go back to Windows.
It's literally the same.
Make a survey
doesn't
on
matter.
the street.
No,
Make a
no,
survey
no.
on the street. Ask 100 people, and then see if they say it's the same.
I think it's potentially, I don't know if it's either a bad example or it's a perfect example, because people do have this sort of overly emotional attachment to their operating system and things like that. Like, more people are militant about their operating system than, I don't know, their like religion or political leanings or whatever it is.
Or the
Yeah.
airline they're flying with.
It's
Or the
crazy.
hotel
It's
that they're
crazy.
using.
It's like, would you ever, the answer when you ask someone, would you consider switching, from Android to Apple or the other way around? The answer wouldn't be no. It would be like, oh, no. It'd be like with a feeling of disgust.
100%.
But anyway.
I mean, there's so much stuff connected, apps. There's so habits on how to search stuff. It's just like you have to change so many habits.
Your whole life.
It is the whole life. The mobile phone for me, the mobile phone is take this away and then
That's why it's such an interesting topic without going into it, because then you really question loyalty. Why do people keep buying the same product? Is it because they're
That's
loyal
why
to
Apple
Is it
doesn't give
because
any
the
loyalty points.
Exactly, because the
Because
lock-in
they know
effect
that you're
is so
locked
hard.
in. They know you're locked in. But again, that's why with the flight, it's a completely
of
different
course.
topic. Credit card, the same topic. It's like a piece of plastic that I just use and swipe everywhere. So obviously, like, changing it from today to tomorrow doesn't change anything in my life. The invoice is the same. I just get another logo on top of it.
True. Fair enough. What an interesting how we're chatty today somehow. I don't know. We're 1.5 topics in and we've reached like an hour and a half already. Interesting. But I mean, it just means that the topics so far have been really interesting, actually. I mean, just going into all of this. And to be honest, when it comes to the next one, like, this is basically the Gabriella show, because we're going into like all of your favorite topics. Totally, man, totally. Because the next one, And, we can spend as much time on this as we want to, honestly, because I think really the two chief topics were the latest two that we just talked about. I think the Clarity Act is something that we're going to keep on watching very closely as it develops in the future. As we've heard, there are real litigations happening, and things do tend to be addended over time. So, yeah, we're just going to see how that progresses. But for now, we can go into a topic that's maybe a little bit more fun and maybe even a little more, I don't know, consumer friendly, I guess. We're talking about collecting airline points when not flying in 2026. This is a really interesting one because, again, it's a topic where if you're an avid points collector or miles collector, you know all about this stuff already. You're an expert. You know exactly which card to use when, etc., etc. If you're not, though, then you're being introduced to an entirely new world full of possibility that you have never heard of before, where you get a lot of rewards based on the different transactions that you make and whichever airline you either prefer flying with or, whichever one hands out the best rewards, depending on your take on the conversation we just had. That being said, this is a very interesting article that was out a while ago. I don't remember. I think this was Business Insider. And yeah, talking about airline loyalty points and, how they started and how they're going. And we've had this episode before where Gabriele broke down the sort of economics of how Airmiles work nowadays and how it essentially saved a lot of these big airlines during COVID, where they were able to use miles, as either as collateral, or they were able to sell them to companies and things like that to stay afloat. And nowadays, it's very interesting because you have articles like this one that breaks down, for example, for each different American airline. So I think he goes into United, he goes into Delta, and he goes into American Airlines, and their various methods of, actually earning miles without ever flying. So yeah, a lot of people do fall into this category. We had the topic of infrequent flyers as well. And maybe there will be a year where you want to save some money, you don't necessarily go on vacation, you're not traveling for work, etc., etc. So you want to keep this thing active. How do you do that? And this is also kind of by far and away actually directly relevant to what we do on the Kiwi side as well, because we also allow a lot of these businesses that aren't flight related to distribute miles to their customers. So this is all basically very, very relevant here. And the interesting thing is, the guy says you can build a meaningful points balance without ever stepping onto a jet bridge, as long as one is capable of understanding where the airlines create points and how to avoid the kinds of traps that make travel expensive. At the end of the day, one does still want to seek out the best way to get free flights. So these kind of programs can be helpful. Of course, the word free in this case is open to interpretation. You're not paying money, you're paying in some other ways. But he opens up on Delta Airlines. And maybe we can start sort of breaking this down a little bit. I don't know how fervent you guys are when it comes to miles and the collection of miles. I know Gabriele, for example, is big with the American Express. And so you must know a whole bunch about this stuff. Gianluca, on your side, are you also a co-branded credit card holder of any kind?
No. Not right now.
Okay, me neither.
but but I do want to get one specific one. Yeah. And it is Airmile related. Definitely. Because I agree with what he says. You always want to see how to get a free flight. Mm-hmm. That's one of those things that is so lucrative about these credit cards. Issuers. Although maybe just to add a little aside, I learned here in Dubai since I moved that, at least compared to Switzerland, that's the only comparison I can make where I experienced it myself, is that over here there's way more co-branded credit cards with all types of loyalty systems, all loyalty programs. It's not just frequent flyer programs. Where in Switzerland, at least as far as I've seen, I'm not sure if there's others, but in my experience, in my little research I've made in Switzerland, it's all related to frequent flyer program or the frequent flyer program, Miles and More. Yeah. I'm not sure about the US. although with the US being a massive market, I'm pretty sure that co-branded credit cards with other loyalty programs is probably also possible. But anyways, here in the UAE, I saw that pretty much all the banks, no matter which one, you can get co-branded credit cards for all the major loyalty programs that are available here, and they're not all airline related. So they're also retail, shopping related, and just also the general. There's one specific one for one of the bigger ones that is related to UAE in general, and you can also get that one. So it's pretty cool to see, and definitely worth it.
Yeah. And in this example specifically, I mean, we're going to notice the running trend here that for a lot of them, it does have to do with the co-branded cards. So, for example, here with Delta, one of the first things that they mentioned is the Delta Airlines co-branded American Express cards, as well as opportunities to generate double miles through things like Sky Miles shopping and a bunch of other stuff. So, yeah, very, very interesting. When it comes to the miles point of things, I mean, Gabriele, for you, or maybe for Gianluca as well. I mean, we've been working with miles for such a long time now, like experiencing miles being used as currencies, as earning methods, as spending options, etc., etc. How do you think it balances? Because it used to be with air miles, you earned them by flying, and then you would spend them flying. And since then, it's evolved into this entire crazy ecosystem. Do you think, has it gotten to the point where the earn and spend options beyond flights has become, just as big, just as important, if not more so than, the ones from the flights themselves? Or are we actually sort of approaching that inflection point at some point?
I don't. If I may, just also to continue or follow up on the point, or the point that I made just now about the UAE. When it's about miles, I still see, as Gabriele said before, that the conversion, I mean, the earning part, 100%. If it's here, and this article sheds some light on it, but it's definitely something that if anyone has a credit card, just try and get the co-branded credit cards. Usually those give you, but always double check. They usually give you more value than at least in my case, they give you way more value for the money spent than the banks give you for using their generic cards. And one thing that I noticed with the point that I made, that here in the UAE, you have all these co-branded credit cards that aren't just miles related, aren't air miles related, is that one thing that I definitely did when researching those and when choosing it is to see where would I wish to spend my points mostly. And not earning, because all of them are very similar in the earning. So the proximate value you get for the money you spend, at least in I didn't go so deep that I made calculations and a spreadsheet on seeing every card and how much I get out of it, but they're very similar in what I've seen. And there, the biggest point was because of what Gabriele was talking about, where when you're within the ecosystem of the loyalty program, spending the points or spending the miles is way more valuable than going out of the loyalty program and spending your miles outside of the loyalty program. I automatically thought to myself, okay, let me see all these credit cards. There's the air mile ones, there's the retail shopping ones, there's the general, there's a big loyalty program here that is a bit more general. You even earn points for spending, for example, just for utility bills, all that stuff. So it's very cool. It's not just even on retail stuff. There's different amount of points you get for different spends you make. And there, the question is really, okay, I'm going to earn all these points anyways because I'm going to use my credit card to pay everything. Okay, so that's the baseline that you anyways have to think about. If you spend everything with your credit card, definitely get a co-branded card because you're going to get so much value out of it for spends that you anyways have to make, right? If I have to go buy groceries, why buy them with a debit card when I can buy them with a credit card that is money that I anyways have on the bank account, that I just then pay afterwards, and I get points for that. And if I'm an avid traveler, I'm definitely going to go for the Airmiles one, because I know the points I'm going to get from spending daily, I'm going to get free flights. But if I say, hey, I want to optimize my spend on groceries, for example, I'm definitely going to get the ones get the retail co-branded cards, so that let's say my daily spend is covered, at least to the extent that I don't have to, maybe the 5%, whatever the value is that I get back, I can then invest, or I can then spend on the groceries, and I have there a few less costs. I opt more for the traveling, because since I moved and I go back home every now and then,
Right.
of course, I'm happy to spend my money to then get a free flight eventually when I then go fly back. But that's a bit the thought process that I had, without going too deep into actually checking all the different spend options.
What's your take on this, Gabriele, when it comes to the cards and their ecosystems, non-airplane specific?
I mean, there are two different types of. So in general, when you look at the airline loyalty program, they have three types of partners. They basically have the airlines, their first partners. So Miles & More has Swiss, Lufthansa, Air Austria, etc. So you fly, get miles, right? Then you have their second largest partners, maybe even the largest ones, are the co-branded cards. So that's, for example, a Swiss card in Switzerland. That's a Deutsche Bank in Germany that issue the official Miles & More card, where you spend money, you earn miles, right? We have like a classic silver, gold, platinum, etc. And then you have all the non-air partners that are also not financial partners. And those could be, it's in the case of Miles & More, this could be a Sixt, that could be a Marriott, that could be where I buy my lenses, Mr. Lens here in Switzerland. I order lenses and I get miles, right? And all the partners that we, for example, onboard. So we're all in that category. And at the end of the day, you have let's break it very simple down. You have the people that fly with Swiss or Lufthansa, etc., when they go to holidays. So the classic, say, family, for example, or a single or in a couple, whatever it is, they have a normal job. They don't have to travel for the job itself, but they go, I don't know, over summer to Ibiza. They go maybe, they make a trip to the US, they make a trip to Asia, but it's like 1, 2, maybe 3 flights, like 1 long haul, 2 short-term flights a year, right? They almost never get enough miles to actually pay the next flight. So they're kind of stuck in between, because they have something, but not enough to get the next flight. And so often their miles expire, and then they're angry that these miles expired, etc. Then you have people that actually are paid by their company to travel. And that's, of course, a very easy choice, because if you have to travel once, twice, 3 times a month, you always put your Miles & More ID in the case of that you fly miles, like that you fly Swiss or Lufthansa. And then you obviously earn a huge amount of miles, get also pretty fast to a certain status. So you get a huge amount of benefits of that specific program, right? And the thing is that the credit cards and also the direct partnerships where you can earn and spend your miles, they're a huge benefit for people that are more in the first category that I described. So they don't fly a lot, they don't fly for business, so they never have enough miles. But now they actually have the opportunity to just use the credit card, for example, every day and get some additional miles. Or they have specific partners that they actually like and they work with. Again, my pedal club here gives miles for Miles & More, of course, powered by Kiwi. Obviously, I play once a week paddle, meaning, yeah, it makes a huge amount of sense to get my miles directly there, right? And it's an additional way how I can earn miles, and I can actually work towards, or I can collect more miles towards a certain goal where I want to fly to. I'm maybe a bit of a special case because, of course, you can use the Miles & More cards for businesses. So this is a bit of a pro advice. Just connect it to all the subscriptions you have. Pay everything you can with your credit card, and you will earn so many miles per month that I think we never pay for a flight, because we always have enough miles that go through that credit card. So there are a few hacks that you can do where you actually earn really quite a lot of miles. But the thing is that these partnerships really help a lot to the long tail of users. So to just summarize, what I want to say is, to the long tail of users, it's a huge benefit, because suddenly I don't have to force fly, basically, just for the sake of earning some miles. But I can actually have all kinds of activities and partners where I can earn additional miles with stuff that I anyways do. Like, again, if I anyways play paddle, if I anyways buy lenses, and stuff like that, or maybe I drive to a hotel, right? But I know I can earn some miles there. So it helps a lot to the long tail to actually experience the use of their miles, because with so many people that I talk that are not paid to travel, they always say the same thing. I have so many miles, but I don't know where to use it, and now they're expiring soon. And I don't know
Yeah.
what to do with it. And they also don't
Been
want to
there.
spend it on a gift card, because they say, no, the value is so low. Like, okay, the value is low, but if you don't need to fly and you don't want to lose your miles, it's like, just take what you can take, right?
Not many options.
Yeah, not many options. Just optimize for the most amount of value. So I think for those people, it would help a lot, because they actually then have the chance to experience maybe side bracket. You also need to find the flight, and you have to often try multiple times or multiple weeks, etc. Like this flight, for example, that I booked last week, I maybe had to search 4 or 5 times. I didn't find it online, so I had to call the hotline. Then suddenly the hotline saw that flight that I wanted, which I didn't see online. There's also weird stuff. For example, I had to book the flight in 2 flights. So Zurich Dubai was one flight, and Dubai Zurich. I had to buy it separately, because apparently you couldn't buy back and forth. So it was only one way was possible.
Oh.
It's like a mix of, I don't have enough miles,
Caveats,
plus then there is the weirdness of these systems with the whole yield management in the background, where the airline tells them, yeah, you can have this amount of seats, right, to the loyalty program, and then the loyalty program has kind of to figure out how to present it to their members, make also difference. And there's also something that I figured out with our youngest brother, actually. He's senator at Miles & More, and he said he sees more flights than a non-status member sees. So we're literally at the same time looking at the same dates for the same city back and forth, and he was seeing certain seats that I wasn't seeing.
Wow.
So there's anyways friction, and if then you don't have the amount of miles to not even like enter that space, it just gets very boring. So having all these co-branded partnerships, the additional partners that we're bringing on board, that they already have on board, that really creates a lot of additional liquidity for the long tail of members.
But if we're talking about additional liquidity, maybe that's very good segue once again for the final question maybe for today. And that has to do with dilution. We're talking about this thing, giving these miles, making them available to so many more people. It brought up a topic that's also in the same article. Wait, that's the wrong one. It's this one. The trickier part for airlines is how to make it easier for more and more people to earn elite status without degrading what status actually offers. This may seem concerning to those who are traditional frequent flyers. Now you can certainly still earn status by traveling both extensively and repetitively. So kind of the famous quote, when everybody is special, nobody's special. So 100%. How do you give the miles to more people and still get the frequent flyers that exclusivity that they like so much?
So the miles that I was talking about, we're talking about award miles. I earn it and I can use it for a flight. Status is a completely different topic.
Mm-hmm.
And there I agree. I 100% agree that it's a difficult topic, because at the end of the day, as a company, I look at who is generating the most amount of value for me, and those people I want to give a certain status. So if they're giving me money by flying or spending more with their credit card, which at the end of the day generates cash for me because the co-branded partner pays then me money, in theory, the more money you generate for a company, the higher your status should be. But if it's too easy to get that status, and airlines had that issue, that's why they also made it more difficult. Lounges are overcrowded. Yeah, so you walk into business lounge and it doesn't feel at all like a business lounge.
Mm-hmm.
And you don't get a seat, food is empty, so zero VIP experience. And and there you really have a dilution of that experience.
Yeah. I think that makes a lot of sense. I mean, that's probably why they have the whole distinction for most airlines between miles and qualifying miles in the first place, right? It makes a lot of sense in that way. Do you have anything to add to this, Gianluca, before we move on to the maybe final conclusions for today?
No, I was going to say the same thing as you just said now. That's why there's that distinction. Some air frequent flyer programs say, okay, yeah, the qualifying miles for status you only get by flying, so it doesn't matter how much you spend. You're never going to be a higher status, which makes sense.
We all keep on reaching for that status. For me, it's still pretty far away. Knowing that you guys are also probably frequent travelers and just working with them all the time, I'm sure that some of these statuses must be very enjoyable. But that's something that I'm hopefully going to be. What?
We don't hear you.
Oh shit! I'm not, by the way.
Ah, no way. I would have assumed.
Since we're paying everything with miles, you don't get, when you pay with miles, you don't get the status miles.
Oh wow. Okay, interesting.
So those are the
ironic somehow. Yeah.
Very ironic, I know. I have it at some places, but not on the site.
The loyalty space continues to impress and surprise. But that is, I think, one of the most important takeaways from today. I mean, just when you think, I keep saying how the space is constantly growing and evolving and everything, and suddenly it throws something in your face that maybe you hadn't even thought to think about originally. So for me, for example, once they started talking about the Clarity Act and how important of a conversation that was, and I listened to the interview, I was like, damn, okay, yeah, this is important. These things tend to happen every couple of weeks. And so some of the most important things that you can do so that you don't miss out on any of this stuff is to listen to our podcast, because that way you are informed about all of the new stuff that happens as it comes out. We always have these times to break everything down. I'll look through some headlines. Gabriele always has some headlines as well that he would like to have talked about on the podcast. And it just makes for a great conversation. And I always leave it thinking, okay, I'm up to date. I'm up to speed. Everything is looking pretty good. Are there any final thoughts, any final takes from either of you guys before we wrap things up for today?
No, it was an interesting conversation.
Yes,
great.
Very interesting.
Ladies and gentlemen, thank you so much. Episode 9, we'll call that a wrap for now, and then we're going to be back to our regularly scheduled programming, meaning 2 weeks from now, the next episode will be out, and then who knows what the crazy headline is going to be that time, but you can be sure that we will be there ready to break it down on Spotify, on YouTube, and you can always follow us on all of our individual channels. I'm always going to link everything down below, as well as the links to the articles that we discussed, so that you can deliver maybe your own takes on them. And don't forget, that's one of the most important things. If people have their own takes or their own interesting tidbits when it comes to loyalty, we're always happy to read those. So be sure to drop those. And with that, I will wish everybody, this day of recording is Thursday, a great rest of your Thursday. And we'll talk in episode 10, our 10th episode. Look at that. Anyway, thank you guys so much for listening, and we'll catch you all in the next one. Take care, everyone.
Take care.
Ciao, ciao.
Bye. Thank you. Bye.